Here's a detailed summary of the 4 pillars of investing. Lessons for Building a Winning Portfolio by William J. Bernstein. Along with its key, clean structure and practical lesson, William J. Bernstein's The 4 Pillars of Investing is a foundational book on long-term, rational investing, rather than focusing on stock picking or market timing. Bernstein emphasizes 4 core principles, the pillars, that every investor should understand in order to build a durable, perfected portfolio. In the book, financial theory, market history, behavioral finance, and practical advice, aimed especially at self-directed individual investors. Bernstein argues that with relatively modest effort, investors can design a portfolio that competes with professionally managed funds without paying high fees or succumbing to emotionally driven mistakes. The 4 pillars.
4 pillars.
Bernstein's 4 pillars are:
4 pillars are
1 theory,
3 psychology,
4 business. Each pillar plays a distinct but interlocking role in constructing a wise investing framework. Here's a closer look at each. At its core, investing theory is about the trade-off between risk and return.
Higher expected returns require accepting
higher risk. Bernstein insists that you cannot have high returns without taking on frightening risk. And if you want safety, you must accept lower returns. He emphasizes the importance of being able to measure and estimate returns, especially over the long run. For example, he uses the dividend discount model, Gordon model, future return model, future return, dividend yield. Bernstein argues that markets are generally smarter than individual investors. Rather than trying to beat the market by picking stocks or timing trades, the most reliable strategy is asset allocation. He discusses the concept of an ideal or perfect portfolio, but stresses that there is no single optimal allocation. Instead, the right mix depends on an investor's risk tolerance, complexity tolerance, time horizon, and willingness to deviate from the market. Tracking error. To history of investing, Bernstein believes that knowing financial history is critical. Market cycles, manias, crashes, and recoveries have repeated themes over centuries. Understanding past patterns helps you prepare mentally and strategically for future ones. He shows that markets are inherently cyclical. Booms, manias, and busts are not anomalies, but recurring features of financial markets. Importantly, history teaches a paradox. Good long-term opportunities often emerge from times of pessimism, and the highest future returns may come after major crashes, not during times of euphoria. He cautions that even with historical knowledge, investing is difficult, but being unprepared is a far worse problem. 3 psychology of investing. One of Bernstein's most powerful insights is that investors are often their own worst enemies. Behavioral biases,
Fear, greed,
frequently drive poor decision-making. He talks about how intelligence does not protect you from behavioral errors. Even very smart people make bad investment decisions under psychological pressure. For example, he famously refers to Isaac Newton losing money in the South Sea bubble. Bernstein warns against exciting investments that seem glamorous or potentially very profitable but carry high risk. He argues that seeking entertainment from investing is dangerous. Short-term losses are particularly psychologically painful, but Bernstein encourages investors to look beyond them. Investing should be treated as a marathon, not a sprint. He also challenges the great company, great stock illusion. Just because a business is excellent doesn't mean its stock will perform well. Markets don't always price companies rationally. Finally, Bernstein warns about over-reliance on forecast, and past-patterned humans tend to see patterns even when returns are fundamentally random. In this pillar, Bernstein shifts to how the investment industry works. Brokers, mutual funds, advisory services, and media, he's quite critical. He points out that costs matter a lot, fees, commissions, and conflicts of interest can seriously erode returns. Bernstein cautions that many financial professionals may not have your best interest in mind. For instance, brokers might prioritize selling high-fee products. He encourages investors to be informed consumers of investment services. Understand what you're paying for, and don't blindly trust media hype or hot fun picks. In the closing chapters, he also covers practical implementation. How to define your asset allocation, your mix, how to get started, how to rebalance, and how to maintain discipline through market cycles. He also gives guidance on retirement planning, estimating whether you're saving enough,
how much real return to expect,
and how to avoid retiring on a diet of Alpo and little Friskies.
key 10 lessons.
Putting it all together, some of the main take-home lessons from the 4 pillars of investing include: asset allocation is more important than stock picking, because you can't reliably predict which stocks or sectors will outperform. Diversifying across asset classes and rebalancing is the most controllable lever you have. Keep costs low, high fees erode returns over decade. Using low-cost index funds is consistent with Bernstein's philosophy. Behavior matters as much as theory. Understanding your psychological biases and designing a system.
Your portfolio discipline.
Mitigate them is critical. Learn from history. Knowing past financial manias and crashes helps you stay mentally grounded. When markets go irrational, know the business side, recognize that the investment industry is not neutral. Being savvy about brokers, funds, and fees gives you more control and can protect your returns. Plan for the long term. Investing is not about quick wins, but steady accumulation, rebalancing and discipline over years or decades. Strengths and criticism, non-technical style, making complex financial ideas accessible to individual investors.
The integration of theory, history,
Psychology and business provides a holistic framework rather than just how to pick stocks.
He doesn't just teach, he helps readers actually design and manage their own portfolio.
Some readers feel his critique of the financial industry is too sweeping or harsh. For example, critics argue that not all brokers or fund managers are self-serving.
The perfect portfolio
Remains somewhat theoretical.